there, everyone. I'm JJ Ramberg, and thanks so much for being here today. We are joined by John Blizzard, President and CEO of Seattle Bank and founder of CD Valet, and Anne-Marie Stonich, Chief Wealth Strategist of Coldstream Wealth Management. We are going to talk about all things CDs and how this sort of old school strategy can be the best approach to savings in today's economy. And before I start, I encourage everyone in the audience, ask questions, ask lots of them. I'll get to as many as I can. Just enter them in the chat. And also don't forget to take our poll. With that, we will get started. Hi, Marie. Hi, John.
Hello.
Hello.
So nice to have you both here today. Anne-Marie, I want to start with you, kind of, if we can just set the scene, big picture. If we look at the balance between risky assets like stocks and then safer choices like CDs and government bonds, how has that changed over the last decade? How's the balance changed?
Thanks, JJ. That's a great place to start. I think this is a fascinating time in history, and it's really important for investors to understand the fundamental changes that are going on. Remember that after the financial crisis in 2009, the Fed held interest rates near zero for nearly 10 years. And during that time, we all became accustomed to the fact that cash held in banks was basically earning nothing. Money market funds and CDs were unappealing, and bonds were yielding very low rates compared to their historical averages. During this time, the focus turned to riskier assets like stocks and bonds or stocks and real estate and alternative assets, where returns were more compelling. Instead of thinking about obtaining yield, the focus was on securing very low interest rates on debt, refinancing again, trying to secure the lowest mortgage rates possible while they were at historical lows. And so, now, today, we are facing a completely different economic environment. Markets have gone through an incredible transformation over the past 18 months, as we've seen a significant rise in interest rates. Since the beginning of 2022, the Fed has risen rates by over 5%. This is one of the sharpest rate increases in history and caught many bond investors by surprise. So while the path to get here was challenging, today we are facing an environment where we can obtain very attractive yields on relatively safe assets, unlike anything we've seen in the last 10 to 15 years.
So when you think of someone's portfolio, what role do CDs play in that portfolio?
Well, the beauty of CDs is that they offer a very attractive yield today with no downside risks. One of the key tenets of CDs are that they're protected from a rise in interest rates. And 2022 was a really difficult year for both stocks and bonds, and it's historically unusual that both stocks and bonds fall in the same year, but that's how last year played out. And with the Fed raising interest rates so quickly, the taxable bond index was down 13%, which is almost unheard of and really scared a lot of bond investors. So today, the yields on bonds are very compelling, and our belief is that the Fed is near the end of rate increases, but there's always a risk of rising rates. It's unknown, we can't predict it. So the beauty of CDs, unlike bonds, is that they are protected from rising interest rates.
So JJ, just to add to that is, when a consumer enters into a CD, they know if they need to take their money out early, exactly to the penny, how much that will cost them. And it won't cost them any principal, to Anne-Marie's point. It may cost them a little bit of interest, but they could refinance a low rate CD and put it in a high rate CD. But if you own a bond and rates go up to what Anne-Marie's talking about, you could lose principal, right? And so CDs have now risen to be 15% of bank deposits. That's over $2 trillion in retail CDs. So it become extremely popular.
John, let's just get down to the nuts and bolts. Explain to me how it works.
How CD works?
Yeah.
Yep. It's you can invest. It could be $1,000. It could be $1 million, and you can invest and pick your term. You can pick 3 months. You can pick 4 years and choose a term that makes sense for you. Choose a rate. You can pick a big internet bank. You can pick a community bank, your local credit union. And you have a wide variety. On CD Valet, for example, we have 25,000 rates we update every week, and they run the gamut of very short term to very long term. And And yeah, you do it online. You can do it in person in a branch. You can do it over the phone and through, the mail. Lots of ways to open a CD, and consumers are using all of those ways. But I think one of the big things happening is in a digital era, is that it's harder. It's been until CD Valet came along, it was much harder to find those local rates. Because 20 years ago, you'd find all the rates in the local paper, right? When everybody read the newspaper. Today, not very many people read the local newspaper. There's not many left. And so online, before CD Valet came along, there really wasn't a good place for consumers just to go find the rates that were available locally even to them.
When I'm thinking about saving my money and I have a variety of different options, why would I choose a CD over something else?
Yeah, usually, and Anne Marie can add to this. Usually, it's you're not going to need the money for a certain amount of time, so you can typically get a higher rate. So if you put it in a savings account or money market, that may change any given day. And so a lot of CD investors like the certainty of a fixed rate over a certain period of time. And some folks think, hey, might need that in 6 months, so they'll lock it up for 6 months. Some are going to have money in CDs for a very long time. If they see a really good rate that's 3 years, 4 years, we've seen them do 5 years, they'll lock down that rate and have that secured, investment.
So yeah. Go ahead, Anne Marie.
I was just going to say, I think the real key is to think about the timing of your cash needs. And the more that you can pinpoint when you need to access cash, the more you can optimize yields. And CDs are perfect for a known cash need, a tax liability, a big outflow, where you can time it and really maximize, okay, this is how I can get the most yield over that particular time period. The other assets that John mentioned, I mean, there's a place for money market funds and high savings accounts. It's really more your day-to-day cash where it's uncertain and you don't know exactly when you'll need it. And right now, you can benefit from a high rate, but we don't know how long that rate will stay at that. So to the extent we can map out your cash flows, CDs are a perfect tool for locking in those higher yields.
Can you explain a CD ladder to me, John?
Sure. There's a couple ways to do a CD ladder, and really, you're just taking a certain amount of money and spreading it out over time. So you always have some liquidity getting created. So maybe you have a 6 month, 9 month, 12 month, 15 month, 18 month type of ladder of CDs. So you're getting the benefit of higher rates, but you're always having liquidity come available to you. But really, there's two ways. You can do it yourself, a DIY approach, and go find CDs that meet those terms and get the best rates. Or you can work with some financial institutions will customize ladders for you. And that is also another great way to do it.
We have a question from the audience, and I'll ask you, Anne Marie. It comes from Bruce, and he asks, why is a CD better than a treasury bond?
It's a really good question because there can be, we'll always compare the yields on both and see, and oftentimes the CD rates will be a little bit higher than an equally, maturity T-bill. Here's the big difference. A CD does not fluctuate in value. A treasury bond can fluctuate in value. And so it's really a matter of trying to determine where you think interest rates might go from here if there is a potential that you need that cash sooner or later than the maturity. So with treasury bonds, again, the CD is locked in. You know exactly what you're getting. With the treasury bond, there's a yield component, and then there is a price appreciation component. So a bit of it is sort of where might interest rates go over this next time frame.
And then this is a good follow-up to it, but do you think of, well, it was asking, do you think this comes from Kay Beerus, do you think of T-bills in place of CDs, which you already answered, or do you think of utilizing a combination of both? Does that make sense?
I think there is a component too of how you're purchasing it. The beauty of CDs and CD Valet is that it makes it very easy for a consumer to purchase. You can do it all online. You can see exactly what's out there. It's giving you a transparent view of all the rates. When you're buying T-bills, it's a little bit more complex. You need to be aware of, you might be buying something, you're buying it in the secondary market. You may be buying it at a premium or a discount, so you have to understand the difference between the coupon rate and the yield to maturity. And so I definitely think there are benefits of both. And if you're, if you have help to buy T-bills, or if that's something you're comfortable and you understand that market, and if you think that there's a higher probability of rates going down in the future, which would benefit a T-bill purchase, then those are all reasons where you may also use a T-bill versus using a CD.
I want to get to why you ended up starting CD Valet in a second, but we're getting a lot of questions here, and I want to make sure we get to those. Lisa asked, what's the difference between a fixed annuity and a CD? Want to take that, Anne-Marie?
Sure. Well, I think of a fixed annuity as a investment where you're earning a income stream that's fixed over time. And I guess the similarities between an annuity and a CD is there's no volatility in that income stream. There's no, it's basically guaranteed. And so the confidence and protection that gives you is clear. I think of a CD as more strategic, like you can buy them for shorter periods of time. It's not as long as a commitment. So I think of them as really different tools, more apples to oranges than apples to apples.
John, what do we need to, if we want to purchase a CD, what do we need to look at? And how do we compare prices, interest rates, et cetera?
Yeah, I think you got to look at multiple pieces. One is like, what financial institutions are you comfortable working with? Is it your local banks and credit unions, and maybe the big internet banks that you know and the names of, and shop amongst those? Is it, do you want to have a place you can go visit and see and drive by, even if you open it online? A number of consumers like that. So a lot of factors to consider when you're buying a CD. Rate is just one component, and geography, term, when do you need the money, and then the financial institutions you're comfortable with. We have the Bauer ratings on CD Valet. You can easily see those as well.
Why did you start CD Valet?
That's a great question. Everybody asks that. And we really, it's like a lot of things, it was out of frustration. So I run a bank as well. And in 2018, we were growing rapidly on loan side, and we needed to grow our retail funding, and CD is one way to do that. And so we offered really attractive CD rates, and we were fairly naive, honestly, in understanding the digital economy at that time. And what we found is, even though we had one of the best rates in the country, it didn't show up anywhere online in the supposed marketplaces that are out there that are really pay to play websites, and really are not marketplaces that show community banks and credit unions. So we also noticed our friends down the street that have a bank and another credit union had really good rates, and those weren't showing on these supposed marketplaces as well. And then we learned, you could pay a lot of money to be on these sites that was well beyond what community banks and credit unions could really pay. And so we realized we were really, thousands of financial institutions, your local banks and credit unions, were excluded from the internet. And this is, 2018. And really, there was no single location. Consumers could just go find all the rates and choices and terms, local, national. And so we set out to do something about it. And that was the start of CD Valet. And to date, it's been about information. We have 25,000 rates on there that we update every week. We've got over 1 million people to the site, and really we're moving it to the next stage, which is where consumers can easily open accounts and invest in the best CDs that make sense for them.
So how do you get the information then?
So it's all public. So we use all the publicly available information from banks and credit unions across the country. If they have a special or something they do internally that's not on their site, we wouldn't capture that. There's no way to capture that. But most financial companies, banks and credit unions post rates on their site, especially in the ultra competitive market we're in today for deposits.
We have another question from the audience. Monique asks that we talk about the tax implications for CDs versus bonds.
I'll speak to that one. So from an income component, the income that a CD pays and that a bond pays, they're both considered ordinary income. With bonds, you do have an opportunity to invest in municipal bonds, so that might be tax-free income. And so again, on the bond side, there's a lot more options to consider, and that ratio between which yield is better between taxable bonds and municipal bonds, it of course, number one, depends on your tax rate. But number two, that relationship shifts over time. So it's fascinating right now to see what yield you can earn on municipal bonds. It's, for someone in the highest tax rates, in some cases it's over 7% now. So again, more options there for tax versus tax-free. But the beauty of the CD, again, is it's just sort of, exactly what you're getting, taxable income, all tax at ordinary income rates.
John, what do you find? And this is our poll question as well. So I hope people will answer the poll, and I want to see if it lines up with how you're going to answer here. But when you're out there evaluating a CD, what are the different things that you should be evaluating? There's the rate, there's the term, what else?
Yeah, there's the rate, the term, the financial institution you'll do business with, how strong are they? Although the vast majority of CDs are insured either by FDIC or NCUA if you're under 250, or you can structure it to have way more insurance than that. But really, do you want a name that you know? Do you want a local institution? Do you want to be able to open it online? We're seeing a big migration to it. Obviously, for folks that want to open accounts online, but some certainly still want to do it in person. So it's a mixed bag of different things to consider, and there's consumers in all those areas.
Why wouldn't I just go and say, I trust this pile of banks or this subset of financial institutions. I want it for 6 months, 5 years, whatever I say, and just go find the highest rate. Is it not as easy as that?
You can most certainly do that. A lot of times we find, and not always for sure, is sometimes consumers, they want a name they know, even though it may be really well-rated bank outside of their market. Some people are very comfortable going ahead and say, hey, I'll get that best rate through that bank in another state or credit union. And some are not. They want to deal with somebody local or a national brand that they know. That may shift over time as things like CD Valet become more prominent and more information is out there and you get a greater comfort level.
Yeah. So what does CD Valet do, if anything, to make you feel comfortable? If I just want to go get the best rate that I can, and can I feel comfortable that if I go onto CD Valet, any of those institutions I can feel safe with?
Yeah, they're all FDIC or NCUA insured institutions, right? So they're all insured, and so that is something everybody should take a great deal of comfort from. And vast majority of CDs are well within the insurance amount. The other thing they do is look at the Bauer rating, which are on the CD Valet as well, so you can get comfortable with the financial institution, that there's not serious problems there based on their rating. And you obviously can do your additional research as well, but they're all insured. That's the beauty of why CDs are so popular, and it's grown to be over $2 trillion in retail CDs, and that's because you get a set rate, your principal's guaranteed, and it's insured, so it's highly attractive to consumers.
Is there any risk I need to be thinking of?
Probably. The only risk would be if you did an amount over the insured limit. That would be something you'd need to be really comfortable with who you're working with. Now, most banks and credit unions are very solid, and the challenges we had last spring were very small relative to all the financial institutions out there. Important, but if you keep within that insured amount, you're going to be in great shape.
We got the answer to the poll. So the poll was, what's the most important to you when evaluating a CD? And no surprise here. The answer, at least to me, the answer was the rate of the CD. So the other options were the term, the minimum deposit, or the financial institution. So it was the rate, which leads me to wonder about promotions, because you had asked about promotions. You'd spoken about promotions before, John. So should I be looking for promotions, and can I find those on CD Valet?
Yes, this is a really important aspect to understand how financial institutions are, pricing their products on CDs and where the best opportunities are. Almost always the best pricing, the best rates for CDs are going to be in a promotional rate. the financial institutions will come out with a 13-month or a 9-month or some odd maturity typically, and it will be a promotion. It'll be their best rate, but it won't be the standard 12, 24-month kind of rate. And so those we see consistently are the highest rates. And so it's a great opportunity there. You do need to be aware of some gimmicks in that area. Sometimes it has to be new money if you're already an existing customer, which is done sometimes. And then the second thing, which is more prominent, is say you take out a 13-month CD at a really high rate. It's a great return. That may convert after 13 months, automatically roll to a 12-month rate that's not very high. And so you really, the savvy savers, and there's millions of them out there investing in CDs, they're well aware of this aspect. But somebody new to the to CDs really need to be careful on that. Is like, you don't want to have a 5% CD that rolls to 1% automatically. And so just be aware when you're going to do that 13-month or whatever, make sure you look also at, hey, what rate will that maybe roll in the future? You can't guarantee what that rate will be, but if there's a huge difference in how they're pricing those today, a little bit buyer beware on that.
Okay, well, that leads me to wonder, can you just give me a list of questions? Like, what question should I be asking this institution that I'm about to buy a CD from?
Yeah, and it's all disclosed. That's the beauty of financial services. This is all stuff that has to be disclosed. Is hey, if you have that promotional CD, what if you don't do anything and it matures and rolls into a new CD? What will that maturity be? And then go look at that rate today and just see what that delta looks like. You know, if they're pretty close in rate, you probably don't have to worry too much. You'll get the market rate at the time. But if there's a huge delta between those, you need to be really cautious. But that's going to be disclosed, what happens after the maturity, and so you can be well aware what's going to go on there.
So on CD Valet, is it as easy as typing in, here's the term I want, find me the best rate?
Yeah, so you can, that's the beauty. You can shop by geography. You can shop nationwide by term. You can look at the promotional rates, which vary all over the board. And so really, you know, if you're in Texas and you want to look at just Texas banks and credit unions, you can easily go on there and just look at Texas and see those opportunities. You can say, hey, I want to look at the 12-month or the 24, or I want to look at all the promotional rates. And so it's a great site for just narrowing down what are your best opportunities to put more money in your pocket through. And a lot of times it's community institutions can have phenomenal rates right near you, and you would never know online otherwise.
Why would I limit it by geography?
Not everybody does. And you know, it's probably 50-50. Some will look anywhere in the country and find the best rate. So you can do that on the site. We allow you to either limit it by geography or just look nationwide and say, hey, you want the best rate for a 12-month, and you can go and find that. You do have credit unions are a little unique in that they have a field of membership requirement. And so maybe you have to live in a state to be able to qualify for that. So my Texas example is maybe for some of the best rates there, you actually have to live in Texas. And so the credit unions are much more narrow in that regard, but they also can have some phenomenal rates.
I see. Anne-Marie, there's a lot of love for CDs right now. We talked about how to look at this in the broader context of our portfolio. Can CDs be valuable to anyone, or are there specific instances where somebody should not be interested in one?
I think CDs have a place in anyone's portfolio. And again, it comes back to looking at sketching out your cash flow needs and figuring out the timing of when you need that and how you can maximize yields. So I always think about CDs for a known large, cash need in it with a definite date. I mean, it's a fantastic way. We are at, interest rates that are historically high, anything over 5% for something as low risk as a CD is fantastic. And so again, I just want to emphasize this point of, I feel like we investors all, got really, I don't want to say lazy, but got comfortable not, checking your cash balances and looking how much you're holding in your checking and savings. If you're banking at one of the 4 largest banks, they have not necessarily raised their rates to where interest rates are. So this is a critical time to think about where you're holding cash. And really minimize the amount that you're keeping in low interest bearing accounts. Look at CDs, what you can lock in great rates. Look at money market funds, think about putting some work in bonds. All of those are important parts of a diversified portfolio for every investor.